You woke up this morning wanting things. Coffee, a bigger apartment, a car that doesn't make that noise, maybe a small private island. Here's the problem. There isn't enough of any of it to go around. Not enough coffee, not enough apartments, definitely not enough islands. Economists call this scarcity, and it is the single reason their entire field exists. If everything were infinite, nobody would ever have to choose, and economics would evaporate overnight. But things aren't infinite, so you have to choose. And economics, stripped of the jargon, is just the study of how billions of people choose when there's never quite enough. Let's speedrun all of it. 1. Opportunity cost. Every choice quietly kills another one. The 20 minutes you spend watching this is 20 minutes you're not spending sleeping, or earning, or staring at the ceiling having a small crisis. That sacrificed alternative is your opportunity cost. The real price of anything isn't the money. It's the next best thing you gave up to get it. Keep that in your back pocket. It explains more of your life than you'd like. 2. Trade and comparative advantage. So how do we get more of what we want with less? We trade. You're good at one thing, I'm good at another. We swap, and somehow we both end up richer without anyone making anything new. The magic word here is comparative advantage. You don't have to be the best at something to benefit from doing it. You just have to be less terrible at it than at everything else you could do. Even if your neighbor is better than you at literally every task, it still pays for both of you to specialize and trade. Being economically useful was never about being the best. It's about being the least bad at the right thing. Comforting, isn't it? 3. Markets and incentives. Pile up enough people trading and you get a market. Anywhere buyers and sellers meet to swap stuff. A street stall is a market. A stock exchange is a market. Your group chat reselling concert tickets at a crime is also a market. The engine that runs all of them is incentives. People respond to incentives. Change the reward. Change the behavior. Make something cheaper, more people buy it. Make it pricier, more people rush to sell it. 4. Supply, demand, and equilibrium. That tug of war has a name: supply and demand. Demand is how much people want a thing at a given price. Supply is how much sellers will make at that price. They pull in opposite directions until they meet at one number where buyers and sellers are exactly balanced. That number is the equilibrium price, and no one chose it. It just emerges. More supply, price drops. More demand, price climbs. It's less a decision than a force of nature. 5. Price controls. Naturally, governments love to argue with forces of nature. When they slap a legal ceiling or floor on a price, that's price control. Cap rent below what the market wants and landlords stop building. Set a floor above it and you drown in surplus. Prices are messages, and price controls are what happens when you shoot the messenger. We'll see that mistake again. We always do. 6. What money actually is. Now, trading apples for haircuts gets awkward fast, so humanity invented money. Money is just a thing everybody agrees to accept, and it does 3 jobs. It's a medium of exchange, so you don't have to find a barber who happens to want your apples. It's a unit of account, so we can price everything in the same units. And it's a store of value, so you can save today's work for tomorrow. Money has been seashells, salt giant stone discs, gold, paper, and now mostly glowing numbers in an app. None of it has any built-in worth. It works purely because everyone believes it does. Money is a shared hallucination we all agreed to take seriously. 7. Banks and interest. Then we invented banks, which are just buildings, increasingly just apps, that hold your money and lend it to other people. They pay you a little to keep it there, charge borrowers more to take it out, and pocket the gap. That gap is interest, the rent you pay for using money that isn't yours. Hold that thought, because interest is about to run the entire world economy. 8. The invisible hand. Step back and something strange appears. Nobody is in charge of getting bread to your city, yet the bread shows up every morning. Millions of strangers, farmers, truckers, bakers coordinate without ever meeting, guided only by prices. Adam Smith called it the invisible hand. It's not magic and it doesn't care about you. It's just self-interest and price signals doing the bookkeeping in silence. 9. Land, labor, and capital. Okay, where does all this stuff actually come from? 3 ingredients: land, the raw planet, soil, water, oil, lithium, the stuff you dig up or grow, labor, humans doing things, building, coding, smiling at customers they'd rather not, and capital, the tools we build to build more stuff, machines, factories, laptops. Mix land, labor, and capital, and out comes output. That's production in one breath. 10. Productivity, the cheat code. But how much output you get from the same ingredients depends on productivity, and productivity is quietly the most important word in this whole video. It's how much you can make per worker per hour. Double it and the same country suddenly has twice the stuff with the same effort. Nearly every difference between a rich nation and a poor one comes down to this one number. It's the closest thing economics has to a cheat code. 11. GDP Explained. To keep score, we add up everything a country produces in a year and call it GDP, Gross Domestic Product. One rule: only count finished things, not the parts. Count the loaf, not the loaf plus the flour plus the wheat, or you're counting the same value 3 times, which is how you lie with statistics. There are a few ways to total it up, but the popular one just adds spending, what households buy, what businesses invest, what the government spends, plus what the country sells abroad, minus what it buys from abroad. Made here counts. Bought from elsewhere doesn't. 12. GDP per capita and its lies. Of course, a giant GDP split among a billion people feels very different than the same GDP split among 10 million, so we divide by population and get GDP per capita, a rough proxy for the average standard of living. Rough being the key word. GDP cheerfully ignores unpaid work, the entire underground economy, pollution, and whether anyone is actually happy. A country can boost its GDP by clear-cutting a forest or recovering from a disaster it caused. It's a useful number that quietly lies to you, so hold it loosely. 13. Growth, booms and recessions. When GDP rises year over year, that's growth, and economies don't grow in a straight line. They breathe. The good stretch where everything expands is a boom. When it shrinks, that's a recession. And when it shrinks hard and stays down for years, that's a depression, the one nobody wants to be alive for. Booms and busts cycle forever, partly natural, partly because humans panic in herds. 14. Inflation and stagflation. Lurking in every economy is inflation, prices creeping up across the board, so each unit of money buys a little less. A slow drip is normal. The trouble starts when prices race ahead while the economy stalls, rising costs and no growth at the same time. That miserable combo is stagflation, the worst of both worlds, with a side of dread. 15. Measuring prices. So why does your usual lunch quietly cost more every year? To even measure it, statisticians track a fixed basket of everyday things: food, rent, fuel, and for some reason always one random gadget, and watch the basket's price over time. That's the Consumer Price Index. When the basket gets pricier, that's inflation with a number attached. 16. Why printing money backfires. Here's the tempting fix. If money is just numbers, why not print more? You can. It's called monetary expansion. The catch is brutal. If everyone suddenly has more money, but there's the same amount of stuff to buy, all that money just chases the same goods and prices shoot up. More money, same pie, smaller slices. You didn't create wealth, you just watered down everyone's savings and called it a policy. 17. Hyperinflation. Crank that far enough and you get hyperinflation, where prices double in days and your paycheck is worthless before you reach the store. Zimbabwe printed $100 trillion notes that couldn't buy a loaf of bread. Weimar Germany burned cash for heat because it was cheaper than firewood. Venezuela weighed banknotes instead of counting them. Every time, the same story, a government tried to print its way out of a hole and dug straight through the floor. 18. Central banks. To stop that, most countries hand the money supply to a referee called a central bank. The Federal Reserve in the U.S., the European Central Bank in Europe, they're not your bank. Their customers are the banks. And they have two big levers. 19. Interest rates and monetary policy. Lever 1. Interest rates, the price of borrowing money for the whole economy. Raise rates and borrowing gets expensive, people spend less, and a hot economy cools down. That's how they fight inflation. Cut rates and money gets cheap, people borrow and spend, and a sluggish economy heats up. Tweaking these levers is called monetary policy, and it's basically the world's most powerful thermostat operated by a committee of economists. 20. Quantitative easing. When cutting rates to zero isn't enough, central banks pull a stranger move. They conjure new money and use it to buy up financial assets, flooding the system with cash. That's quantitative easing, printing money with extra steps, a spreadsheet, and a more respectable name. 21. Where money really comes from. Which raises a deeply weird question. Where does most money actually come from? Not a printing press. Loans. When a bank approves your mortgage, it doesn't hand over someone else's cash from a vault. It types the number into your account, and brand new money exists. This works because banks only keep a fraction of deposits on hand and lend out the rest, betting we won't all want our money back at once. It's called fractional reserve banking, and yes, it's basically held together by vibes and the assumption that you'll stay calm. 22. Bank runs and deposit insurance. And when everyone stops staying calm and demands their money on the same day, the bank simply doesn't have it. That's a bank run, and it can vaporize a healthy bank in an afternoon. To stop the panic, governments guarantee your deposits up to a limit. In the U.S., that's the FDIC. The insurance mostly works by making the panic pointless, which is the only thing that ever calms a crowd. Taxes. Now the part everyone loves, taxes. Governments build roads and schools and very expensive jets, but they don't sell anything, so they take a cut of everything you do. Earn money, income tax, spend money, sales tax, own property, property tax. Sell an investment at a profit, capital gains tax. Enjoy a vice, there's a special tax waiting for your cigarettes and your beer. Some systems are progressive, where higher earners pay a higher rate, and some are flat, where everyone pays the same slice. Either way, the letter always finds you. 24. Public goods. Where does that money go? Largely to public goods, things everyone benefits from but nobody would voluntarily pay for alone, like national defense, street lights, and clean air. Left to the market, these get underfunded. Because why pay when you can let your neighbor cover it? So the government foots the bill and sends you the tax. 25. Budgets. Deficits and national debt add up what a government takes and spends, and you get its budget. Spend more than you collect, and you're running a deficit. Collect more than you spend, and you've got a surplus. A creature so rare most governments have only heard legends. To cover the gap, governments borrow by selling bonds, IOUs that promise to pay you back later with interest. Stack up decades of deficits and you get the national debt. The U.S. is past $36 trillion. Japan owes more than twice its entire yearly economy. Almost everyone is in the red. 26. Debt servicing and default. Is debt bad? It depends entirely on what it buys. Borrow to build infrastructure that grows the economy and the debt pays for itself. Borrow to plug holes while interest piles up, and eventually a chunk of the budget goes to nothing but paying interest on old debt. You borrow just to pay back what you already borrowed. Push it too far and a country can default. Stop paying altogether. Argentina has done it so many times economists have lost count. When the lenders stop trusting you, the whole thing unravels fast. 27. International trade. Time to zoom out to the whole planet. No country makes everything well. One's great at growing coffee, another at building machines, so they specialize and swap. That's international trade, comparative advantage scaled up to nations. Both countries end up with more than if each tried to do it all alone. 28. Free trade and globalization. Let goods flow freely across borders and you get free trade, and when it knits the whole world into one giant interconnected market, that's globalization. It makes everything cheaper and more abundant, and it also gut punches whoever used to make those things locally. Cheaper TVs for everyone, an empty factory town for some. Globalization keeps that bill quiet, but somebody always pays it. 29. Protectionism, so governments fight back with protectionism. They add tariffs, taxes on imports. They set quotas, hard limits on how much can come in. They hand subsidies to local champions and slap embargoes on countries they're feuding with. It shields domestic industries and feels patriotic, but it usually just makes everything pricier for everyone at home. Protection has a cost, and it lands in your cart. 30. Currencies and Forex. Trade across borders means juggling currencies. A Japanese carmaker wants yen, not dollars, so somebody swaps one for the other on the foreign exchange market, Forex, the biggest market on earth. The exchange rate is just how much of one currency another one buys today, and it never sits still. 31. Floating, fixed and manipulation. Some currencies float, drifting on supply and demand. Others are fixed, pegged to something steadier and held in place by sheer will. When a currency weakens, the country's exports get cheaper and its imports get pricier. Good for selling, painful for buying. Some governments quietly nudge their currency down to keep exports cheap, which is politely called currency manipulation and impolitely called cheating, depending on who's doing it to whom. 32. Currency crises. And when a country borrowed heavily in someone else's currency and its own suddenly collapses, the debt becomes impossible to repay overnight. That's a currency crisis, and it has flattened economies from Asia to Latin America in a matter of weeks. Money problems travel faster than anything else. 33. Supply chains and shocks. All of this rides on supply chains, the invisible relay of steps that turns raw stuff into the thing on your doorstep. They look unstoppable until one link snaps. A single ship wedged sideways in the Suez Canal froze a chunk of global trade and burned billions a day. A shortage of tiny computer chips once made used cars cost more than new ones. When the chain breaks, it's called a supply shock, and it reminds everyone how fragile normal really is. 34. Your job, labor and wages. Let's bring it home, to your job. Your work is bought and sold in a market too. where you're the supply and employers are the demand and the price is your wage. In theory, scarce skills earn more. In practice, a company keeps you only as long as you produce more value than they pay you. The gap between what you generate and what you take home is their profit, not yours. Push wages up too fast and, well, say hello to the self-checkout machine. 35. Unemployment. When people want work and can't find it, that's unemployment, and it comes in flavors, between jobs, wrong skills for the new economy, or laid off because the whole economy is shrinking. And here's the dark trick. If you give up looking entirely, the statistics quietly stop counting you. Out of sight, out of the number. 36. The minimum wage fight. The minimum wage is the floor under all this. Set it sensibly, and it lifts the lowest paid without much harm. Set it sky high, and employers cut hours, raise prices, or replace people with kiosks. Economists have argued about exactly where that line sits for decades, mostly by yelling at each other with graphs. 37. The wage gap. Then there's the wage gap, why some people earn wildly more than others. Skills and experience explain part of it. The rest is discrimination, luck, who your parents were, and raw bargaining power. Top executive pay has exploded from a few dozen times the average workers to hundreds of times, not because they got hundreds of times better, but because they're the ones who set the pay. Labor markets are messy precisely because people aren't widgets. 38. Finance, stocks, bonds, and crypto. Money you don't spend, you can put to work. That's finance. The world of trading claims on future money. Stocks are tiny slices of a company. Bonds are loans you make to governments or corporations. Derivatives are bets placed on top of other bets, useful for managing risk right up until they detonate. And crypto is, depending on who you ask, the future of money or a casino with a blockchain. Mostly, so far, a casino. 39. Markets, risk, and diversification. One famous idea says stock prices already bake in every piece of public information, so you can't reliably beat the market without luck or a crime. That's the efficient market hypothesis. The deeper rule underneath it all is the risk-return trade-off. Safe assets pay little, risky ones might pay a fortune or nothing, which is why the only free lunch in finance is diversification. Never bet the whole house on one meme stock, no matter how good the meme. 40. Why some countries stay poor. Zoom all the way out, why are some countries rich and others stuck? The textbook says just build factories and trade. Reality laughs. History matters. Places that got their resources stripped out by empires started centuries behind. Geography matters. Landlocked or disease-ridden countries fight uphill. And institutions matter most of all. If the rules are whoever bribes hardest wins, investment runs away. There's even a resource curse, where striking oil somehow leaves a country poorer, because the whole economy bets on one thing and forgets how to do anything else. 41. The poverty trap. Poverty has a way of locking itself in. If you're poor, you can't save. If you can't save, you can't invest. If you can't invest, you stay poor. It's a loop, and climbing out is like scaling a wall greased with butter. Aid sometimes helps, and sometimes just funds a dictator's car collection. The things that actually seem to work are unglamorous, education, secure property rights, working infrastructure, and not collapsing into chaos every few years. 42. Why you're bad with money. All of this assumes humans are cool, rational calculators. We are not. We are walking bundles of bad instincts. We grab a small reward now over a bigger one later. We feel a loss about twice as hard as we feel the same-sized win. Throw out a wild number and it warps every price that follows. We copy the panicking crowd. And we'll sit through a terrible sequel just because we paid for the ticket. The field that studies all this beautiful irrationality is behavioral economics, and it explains why you are the way you are with money. 43. Nudges. Because we're so predictably irrational, governments and companies started gently steering us with nudges, making the smart choice the default. Auto-enroll people in retirement savings and suddenly they save, not because they got wiser, but because doing nothing now works in their favor. Same lazy human, better default. 44. Capitalism, socialism, communism. Step back to the biggest question. Who decides what gets made and who gets it? Capitalism says let private owners and markets sort it out. Fantastic at innovation, also fantastic at inequality. Socialism pushes for collective ownership and sharing the pie, strong on fairness, weaker on motivation. Communism takes it all the way, no private property, the state plans everything, flawless on paper and historically a fast track to breadlines and worse. 45. The end. Recap all of it. Here's the punchline almost nobody admits. No real country runs on one pure system. Every functioning economy on Earth is a mixed economy, markets plus government in some uneasy ratio. The whole loud argument is really just about the mix. Every system is only ever answering the same three questions: what do we make, how do we make it, and who gets it? No one has nailed all three at once. So, in 20 minutes, scarcity forces choices, and every choice has a cost. Trade makes everyone richer, money makes trade easy, and incentives quietly run the whole show. Governments tax, spend, borrow, and occasionally set the economy on fire. Global trade is powerful and fragile at the same time, money is stranger than it looks, and no economic system has ever fully worked. That's economics. Almost all of it, at speed. This took an absurd amount of coffee and an unreasonable number of takes to put together. If you got even 1-0, that's how it works moment out of it. Do the one thing that actually feeds the algorithm and hit like. Consider it your tiny contribution to the supply and demand of this channel. If enough of you do, the next all of it in 20 minutes is already loaded.